Hello, this is Rebecca Bennyworth. This session for Tolley Seminars Online is about the savings and pensions measures announced in the budget on Wednesday the 19th of March 2014. Savings was a big area for the Chancellor in this year's budget, and he announced some quite radical changes to savings products, but also some much more unexpected changes to the pensions arena in relation to defined contribution or money purchase pension schemes. So to start with the savings measures, the Chancellor announced a revamp of the ISA savings scheme. This will actually come in from the 1st of July 2014, and under the proposals, ISAs will no longer be segregated into cash and stocks and shares ISAs. So savers will be able to save the full amount per year in either cash or stocks and shares, or a combination of the two, and there'll no longer be a requirement that at least half of the annual limit is saved as stocks and shares. So the stocks and shares elements of existing ISAs will be merged into the new ISA or NISA. From the 1st of July 2015, the annual limit will be increased to £15,000. It's currently quite a bit lower than that, in the region of £11,000. So savers who want to save from the beginning of the tax year will have to stick to the old limit until after the 1st of July and then top up to the £15,000 limit. Do note it's not an additional £15,000 from the 1st of July if you've already made some savings into an ISA between the 6th of April and the 30th of June. There'll be more investments available within the stocks and shares part of an ISA, because to make the segregation in the past, bonds with a life of less than 5 years were not permitted to be held in ISAs, as they were regarded as part of the cash element. So one or two new forms of investments will be available through ISA schemes. But it's up to the providers to advise their customers what they're likely to be able to channel their ISA investments into. At the same time as the main ISA limit goes up, the limit applying to junior ISAs, and therefore also to the old child trust funds that remain, will be increased to £4,000 a year. Now, the next area of change in savings won't start until the 6th of April 2015. At that point, the starting rate for savings, which is currently 10%, will be replaced by a 0% band. This means that people with only a small amount of income don't need to open an ISA to benefit from zero income tax on any interest they receive. So the reduction in rate is also accompanied by a significant increase in the width of the band for savings income. It's currently just under £3,000, and it will rise from April next year to £5,000. So an individual with low non-savings income, maybe around £10,000 a year, which would be using up most of his personal allowance, will be able to receive considerable amounts of savings income without paying any income tax on it. Remember that the savings income starting rate band is the first element of your taxable income. So if someone had a salary of, say, £17,000, they'd not benefit from the starting rate for savings, because their taxable non-savings income would extinguish that band. On the slide, I've raised the question of administration, and I think HMRC are intending to very, very widely publicise the availability of an election to receive your bank interest gross. Otherwise, they're going to be flooded out with claims for repayment of tax, assuming taxpayers are aware of this. So it'll be interesting to see how the admin costs build over the first year that it's in, between 2015 and 2016. I think it is another measure mainly aimed at older savers who are likely to have lower income. And another savings measure targeted at the same demographic is the Granny Bond Mark II. Most of the people listening probably remember Granny Bond Mark I, which was an inflation-proofed government bond. This one isn't inflation-proofed, but it is a much higher rate of interest than is currently available on the market. Now, the interest rates won't actually be confirmed until the autumn statement 2014, so somewhere around the end of November, first week in December. But the sample rates they've given us say that a one-year bond would pay, on current rates that are available in the market, about 2.8%. 3% before tax, and a 3-year bond would pay 4% before tax. The interest on these bonds will be taxable, but of course it's anticipated that many of the savers will probably be within that £5,000 starting rate for savings, and therefore not actually paying any tax on this income. So they'll only be available to investors over 65, and again quite a popular move for what's been termed by the newspapers the grey vote. Now we turn to the pensions measures, and they were probably the biggest news of the budget. Let's start with the measures that are actually coming in next week, the 27th of March 2014, so depending on when you're listening to this, it may already be in. What the Chancellor has done is changed a number of the limitations around pension pots just to loosen up the rules slightly. So we've got some changes to the limits in relation to trivial commutation payments and small pots, generally making them more generous. The figures are in the notes pack. You don't really need to know the figures off by heart. I think the key things to be aware of are in relation to drawdown pensions, which will go at the end of the current tax year. But at the moment, the drawdown limit for anyone who's subject to the limit will be increased next week to 150% of government actuary figures. This was originally introduced at 100% and then increased last year to 120%, and now we're seeing this increase to 150%, so allowing people to draw off their pension funds more quickly. You will probably remember that provided you have a substantial amount of guaranteed other income, so probably an occupational pension, then you are permitted, if you are in drawdown, to take what's called flexible drawdown and draw as much or as little as you like in any year. The flexible drawdown arrangements currently have a required guaranteed income of £20,000 a year, and that will reduce so that from a drawdown year starting after the 27th of March 2014, you will only need £12,000 of guaranteed income in order to go into flexible drawdown and draw down any amount you want. And of course this is heading towards the major change that we're going to see in 2015. So let's now look at that in a little bit more detail. What the arrangements will do is allow those with a money purchase scheme to take the fund whenever they like, subject to a minimum retirement age. That's currently 55, but it's likely that it will go up to 57, and it will then track the state retirement age, which within a few years will be 67, so it will remain 10 years before state retirement age. Once the fund has been drawn, the individual would normally pay 55% tax on any amount over the 25% tax-free lump sum. In future, that rate will reduce to the taxpayer's marginal rate of tax. So 25% of the amount crystallised will be tax-free, and the balance will be taxed at whatever rate the taxpayer is liable to pay on income. So the drawdown will sit on top of their income for the year. The government's expectation is that many, many more people will take their whole pension and invest it in another way. Rather than buying an annuity, they might buy, for example, a rental property, which you can't hold at the moment within a pension fund directly. So it would enable people, if they wanted to invest in rental property, to crystallise their fund, albeit taking a tax clawback, but they've had the benefit of the growth on that tax relief they've had on ingoing investments, and then to actually invest that in one or more residential rentals to provide them with an income in retirement. So I think there are lots of things that people will start to think about doing. The government also announced free face-to-face advice at the point of retirement for anyone who is affected by these new rules, although it's clear that government isn't going to finance this, and it will be an obligation placed on pension providers or in trust-based schemes on the trustees of the scheme. This could be a significant extra cost, and I think pension trustees are going to have to think about this quite carefully. A significant tax yield is forecasted, starting at about 320 million in the first year in which these rules are available, and rising over a 4-year period to £1.2 billion. Obviously, it's very difficult to predict how many taxpayers are going to liquidate their funds. And there are worries expressed about taxpayers who might spend all the money and then fall back on the state. But I think the changes we'll see with the flat rate pension coming through and effectively the marginalising of the pension credit means that actually there will be minimal state help to help these individuals. It does also mean, if you're an absolute cynic, that funds are available should the individual need long-term care. Then had they bought an annuity, those funds would not be available to pay for long-term care. But if they liquidate their pension, then of course they may well be available for long-term care because any assets they invest in would be personally owned. And then finally, by liberating the back end of pensions, there is a building view that this actually presages the abolition of tax relief on ingoing contributions, which would really mean that pensions become a savings product. And I think then we would see a very, very radical reform and indeed a large simplification. Maybe pensions become united with ISAs with, let's say, a £40,000 annual limit on an ISA and the removal of tax relief ingoing, tax-free growth in the fund as we have on an ISA, but of course also the removal of the tax charge when the funds mature. So I think that's an interesting dynamic to think about and might be something that would be considered by a future government. Well, that's the end of my summary on the savings and pensions changes in Budget 2014. This is one of a series of lectures and I hope you found it useful. Thank you for listening.